In horizontal growth, the company seeks to take the current proven concept and profitable operation and expands it either by entering new geographies or by expanding its product portfolio. We are going to get deeper into the different growth strategies and options in a separate course on retail growth and expansion. As discussed before, when there is still growth potential in the industry, the company rather focuses on concentration growth strategies. However, when growth starts to plateau because the market has been saturated, this is when corporates start thinking about diversification strategies. A company can diversify its business by either going for concentric diversification, and this is by diversifying into related industry, or conglomerate diversification by expanding into different industries. A company might choose not to pursue a growth strategy at all and instead focus on stability by continuing its current activities without change. This is mostly favored by small businesses, where the owner has established a profitable business and is satisfied with the current size of the company and doesn't wish to grow further. While this could be a viable option on the short term, on the long run, it might be dangerous for the business. The most common stability strategies are pause, proceed with caution strategy. This is more of a timeout and rest period before pursuing a growth strategy. No change strategy. This is where the company continues to operate the same way and only adjusts its sales and profit goals for inflation. A lot of small local retailers followed this strategy until Walmart came to their town and forced them to rethink their strategies. Profit strategy. This happens when a company is going through a tough time, but the management chooses to stand still and try to generate profits by minimizing costs and reducing investments or expenditures. It can only work for so long before the company position starts deteriorating and losing its competitive advantage. So the management rather go for a retrenchment strategy instead. Retrenchment strategies are pursued when the company starts having a weak competitive position in the market and starts losing money. Retrenchment strategies include turnaround strategy, captive company strategy, sell-out divestment strategy, bankruptcy liquidation strategy. In a turnaround strategy, the company tries to improve its efficiency by cutting costs and selling non-performing assets. The process typically goes through phases of contraction followed by consolidation, where in contraction a lot of jobs are lost and stores are closed. And then in the consolidation phase, the company tries to stabilize the now leaner business. When a company has a weak competitive position and will not be able to go for a turnaround strategy, it might opt for the captive company strategy, where it sacrifices its independence for the sake of its security. This is done by offering itself to one of its largest customers and trying to be its exclusive supplier through a long-term contract. If a company fails to go into turnaround or captive company strategy, it might be time to think of a sell-out or divestment strategy, where the company looks for someone to buy it, and this is a sell-out, or it can start selling off some of its business lines, and this is called divestment. If all of the above fails, the company has only few options left, and these are bankruptcy or liquidation. In bankruptcy, the company goes under court supervision to settle the claims on the company. The management hopes that the company can get out better after settlement and might be able to compete again in a better environment. Another option is to go for liquidation, where the company sells its assets and returns the proceeds to the shareholders after covering all its obligations. The benefit of liquidation is that it's managed by the board of directors rather than bankruptcy court, which may choose to ignore shareholders completely. Using portfolio analysis, a company with multiple product lines or business units can decide on how to manage these different business units in order to boost the overall performance of the company. In such analysis, the corporate headquarters acts as a banker who analyzes different businesses and decides which ones to invest more in to get the best return on investment for the whole corporation. Using the BCG gross share matrix, the company can plot all the different business units or product lines on a graph based on the growth rate of the industry it's in and its market share in that industry. The relative competitive position is calculated by dividing the market share of the business by the largest competitor. If it's above 1, then the business unit is a market leader. A separating line is drawn at 1.5 relative competitive position because a business unit or product line above this level can ensure a dominant position that enables it to be a star or cash cow. Then circles are drawn for each business unit or product line, and the area of the circle represents sales contribution or assets by this business unit, which represents its significance to the business. Units are then divided into question marks. These are new products or categories that might have a potential to become market leaders and cash cows in the future, if they are given enough investment. Management needs to decide whether or not to invest in them based on their potential. Stars are market leaders and are able to sustain themselves by generating enough cash and even contribute to the company as a whole. When a star's growth rate slows, it becomes a cash cow. Cash cow is a product line in its maturity stage and starting to decline. It does, however, generate more cash than it needs. Such cash can be used to support the growth of new question marks. Advertising and R&D costs should be reduced on this product line and used for other products. Dogs are the ones who don't produce cash and have low market share. They should either be sold off or managed carefully so that they don't consume much cash and other resources. The goal of the company is to maintain a balanced portfolio of business units or product lines where cash generated from cash cows can be used to fund new question marks that can then grow and become stars and then cash cow themselves, and so on. Portfolio analysis helps the management in utilizing and managing cash across the different business units. Corporate parenting, on the other hand, addresses questions about what industries the company should be in and how to better utilize companies' resources and capabilities across the different business units to achieve synergies. The main job of corporate headquarters in this case is to direct the company's resources and transferring skills and capabilities between the different units in order to attain economies of scope. The company can do this by examining each business unit and to identify its critical success factors and its areas of performance improvements, and then decide whether, as a parent, it is fit to parent these business units by having the required resources and capabilities. The final level of strategy is functional strategy. Functional strategies should work to enforce the chosen business unit strategy. For example, a company that's pursuing a competitive strategy through differentiation based on quality will need functional strategies in buying and product development that ensures the highest quality products are sourced. It will also need to enforce the same throughout the marketing message to convey such value proposition. Also, the hired sales team should be chosen and trained to sell such products and have the required skills to do so. A company that follows a cost leadership strategy, on the other hand, will have different functional strategies that enforce low-cost positioning. This will be seen in different buying strategies, hiring strategies, financial strategies, and operation strategies.